it's great to be here. My name is Brian Strain, and as we announced last week that we were going to be letting me talk a little bit today, I'm just going to give you an introduction about me, myself, and how I got here, and why Kevin brought me on. And I encourage some of you know that you've been in my courses before. Some of you know to go ahead and interrupt me with questions when you have them. And I like to make sure I get your questions answered within the context of when you had the question. And so that's going to work good. All right. I think I've got everybody in here that said yes. I'm just gonna, cool, there we go. All right, ready for questions when you have them. Let me just tell you a little bit about myself. My name is Brian Strain, and that's a picture of me there and a picture of my website. Some of you may already know me because I've been in the education industry for about 3 decades, just kind of like Kevin. So we're similar in experience and with our education background. I've been teaching people for nearly 3 decades, and you can learn more about me on my website. I've posted my address right there. I'll go ahead and post a link here in the chat just so you guys have it. All right, that way you can go and check things out there. I've got some examples of things that I've done there. That the interesting one is when I was teaching my son the importance of investing and starting a retirement account, and we both put $1,000 in an account so I could show him what's possible. There's a blog post on that that you might be interested in seeing, and I've got statements and things that go there. So what do I bring to Hurley Investments? That's a great question. What do I bring? Well, I am an options and volatility expert and options probability expert. I started a long time ago. I started working at Metastock, and I moved on from Metastock to work with Don Fishback, who is also an options and probability expert. He's one of the leading experts in the field. He's taught me a lot of good stuff about option trading. And I know some of you might think that options are a dirty word, and maybe it just enters your mind that, oh, options are so risky, because I've been doing this for a long time, and I've talked to a lot of people, and that's almost always the first thing out of their mouth when I tell them that I trade options. They're like, oh, those are so risky. Well, if you don't know what you're doing, that's true. But you could say the same thing about stocks. If you don't know what you're doing, trading stocks is risky. But with options, it's actually a little different, because your risk is actually less than risk of owning the stock, because you're only putting up a fraction of the cost of the stock to buy an option. And that means that you actually have quite a bit less risk. So you might be wondering what this image is right here, and it's one of the things that I use to help me value options, which I'm sure we'll get into and talk about a lot on different opportunities. We'll have to go over that, but it's something that Don Fishback created that lets us compare what the market's expecting, the green line here, versus the way the stock's actual distribution has been in the past. And so it's really useful in finding out when options are cheap or expensive. And we can talk about that at a different time. But yeah, I've been doing this for a long time. one of the things I did when I first got started in this business, I wrote an article and I got the cover story of Stocks and Commodities, Technical Analysis of Stocks and Commodities magazine. That was way back in, I think that was 95 or 96. So I got my start working in technical analysis, and this is talking about one of the systems that me and a buddy created. That was really good. I started my career working at Metastock in 1995, and my job there was to go to conferences, meet with industry gurus, and try to sell software to their clients and them. And so I went to all kinds of conferences all over the country. I was exposed to a whole bunch of analytics and a whole bunch of different ways of looking at things. So I became very experienced, and I quickly noticed that Don Fishback was one of the best, and he just made the most sense. He was using logical trading methodologies that had actual explanations of why they worked, which was fantastic to me. So I, going to these conferences and stuff, I hit him up for a job, and in 1998, the timing was just right, and he brought me on. And so from that point forward, I've been working closely with Don. I've also worked with some other industry gurus like Chuck Hughes. I have a teaching degree, and it's funny because most of the gurus and the people out there, a lot of them do not have good teaching skills. A lot of them are not necessarily backed up by data, and so that's one of the things that I bring to the table, is that I help these guys. I've been sought after to help them develop courses that are teaching, that make sense, that are logical. And so that's what I've been doing for many years. Don kind of trained me as his replacement when he retired. He wanted me to take over his education business, and that happened in January of this year. And I started whatareoptions.com, and I see JP on there, and JP was a member of that. So it's good to have you here, JP. And we had a great year last year. It was my best year ever. And we were talking about, me and my partners were talking about marketing budgets, and we were talking about the state of the education business with all these different exchanges and brokerage firms just giving away free education. A lot of people didn't feel like they necessarily needed to pay for education anymore. And that made me really happy, because that means there's a whole bunch of people out there that don't have a great education, taking the opposite sides of my trades. So I'm fine with that. But the problem is when I'm trying to run an education business, it makes it difficult to market and be in a price range that is profitable for the business. And so in April, and you can go and look at whatareoptions.com too if you want to just go see what we were doing there. I still have that site up. It'll probably come down at the end of this year. But some of you, like JP, already knows what's there. But after having one of the best years ever, and talking to my partners who I was trading their account as well, and everybody said, you know what, Brian, there's so many more people you could help that just don't have time to learn how to do it on their own, that you should just go get your license. So I called Kevin. He'd been recruiting me since about 2018. We met in 2017, and he finally, I we talked for a little bit, and I was finally convinced, go get my advisor's license and come to work for Kevin. And that's what I did. So now you know a little bit about my story and kind of how I got here. I should say it doesn't really mean anything, right? You don't really care about that, but what you do care about is what can I do for you? Many people are terrified of options trading because they're certainly more complex than stock trading. With the stock, if you buy a stock, you think it's going up. If you're right, you win. If you lose, if you're wrong, you lose, and it's about a 50-50 bet. And so I like to use this picture here to show you a little bit about what I bring. And so this picture, you can see here we got a 50-50 bet. I've got this triangle showing the probability, and we've got risk on one side, reward on the other side, and this is a balanced view, right? So this is similar to an example of this is if you toss a coin, you got a 50-50 chance of winning, just kind of like picking stock direction, 50-50 chance of winning. And if we were to play a game and every time you correctly identify the coin toss, you get $1 from me, and every time you don't get the answer correct, you give me $1 back. Anyone have an idea if we did that all day, if we just flipped coins all day, does anyone have any idea of how much you're going to walk away with at the end of the day? Think about that. $1 if you win, or $1 if you lose on a 50-50 bet. How much should you have at the end of the day? 0. Exactly right, Russ. Yep, excellent. You're going to walk away with the exact same amount of money that you came in with, right? Exactly. You're not going to have any profit and you won't have any loss. And this example just illustrates what how you balance risk, reward, and probability. And as far as I'm concerned, we hear people talking about risk and reward constantly in the market. It's constantly talking about it in the market, risk and reward. And any conversation that involves risk and reward that doesn't talk about probability, I 100% believe the conversation is useless. Because unless you know the probability, the best risk reward out there potential that you can get, we should all be putting our money into the lottery, especially when it gets up to 1.8 billion, right? Like it was recently. We should all be playing the lottery. If risk and reward is the only thing that matters, why are we putting money into the stock market when we could put our 401k money and just buy lottery tickets? Well, we all know instinctively that that's a stupid idea, that the probability of winning is so remote that that's a terrible idea. So risk reward, it's a wonderful idea, but risk reward and probability, it's a terrible idea. So now this is a 50-50 bet that I can totally get behind. Now, so a little bit more about me. I'm the oldest of 6 kids. And what that means is I win, right? When we're playing games, it doesn't matter. I'll cheat if I have to. But yeah, I don't ever let my siblings win at anything. And so I just win. And so if I could convince them to play the coin toss game with me, and every time they win, they get $1 from me, so that's my loss. Every time they lose, I get $2. That's a game I want to play 24 hours a day, 7 days a week, as many times as possible, right? Because my reward is, it's going to lean this way to the right and favor me. I'm going to make on average, the math will tell you that you're going to make about 50 cents. So if the risk is $1 and the reward is $2 and the probability is 50-50, I should make 50 cents on every bet on average over time. That's an expected return formula. Now, it doesn't matter what the probability is, it's how you balance those things. So you can have a situation where if you win really big, but you only win 20% of the time. Well, if that 20%, those 2 wins out of 10 are big enough to more than offset the small amount of loss that you have when you lose, then even though you don't win very often, that could be a wonderful trade. That could be a great trade. And I know JP knows this because we did that a lot last year, didn't we? And we had my best year ever. You can go check out the statements on my website if you like to. Here's the opposite situation. What if our risk is really big and our reward is really small? And our probability is that we win 90% of the time. That could be a good trade. Because when we risk, we only lose maybe 1 out of 10 trades, but the reward potential, if we win 90% of the time, we're going to win on 9 trades, and if what we win is much larger than what we risk on the 1 loss, then that's a good high probability trade. This is the formula that we use. It's average win times probability of profit plus the average loss, which is always a negative number, times the probability of loss. That gives you your expected return. And this is how those formulas work out. The middle one right here is the fair bet. And this is where I win $2 for every one that I lose, and this is where I win 90% of the time. If I win 20 bucks 9 times out of 10 and only lose 100 bucks 1, then I'm going to have a positive expectation. I should say at this point, so this is just this is how we're balancing risk, reward, and probability. We're using these numbers to make sure that when we're taking a bet against someone else, there's always someone on the opposite side of your trade. And whenever you take a trade, you're saying, I'm smart, you're stupid. If you knew what I knew, you would be pricing this option or this stock wildly differently. And it's going to result in profit for me in the end. So why should we be looking at option trading? And if you look at this, so this is a graph that I got from the Option Clearing Corporation, the OCC. This is this is option volume. This is the number of options cleared by the OCC. And you can just see every year it's been growing, and it lately, and this is COVID. Since COVID, you can just see it's almost exponential growth, right? It's just options are becoming much more popular, and they're so flexible in their use that you can design your trades to do all kinds of different things. One of the great things about options that I love is that you don't have to make directional bets. You can bet solely on volatility expectations and win without having to choose which direction the stock might go. So what does this popularity mean? It means the greater availability of options increases our chances to find mispriced options, because again, we're not interested in any fair games. We don't want to play fair. And that's one of the problems that's out there in the market, is that all these option pricing models, all of these experts that talk about bid-ask spreads and all these different things, they're all pricing options saying that the market's going to lean towards the fair bet. Well, it really doesn't always do it. The market's pretty efficient, but there are plenty of opportunities where options are mispriced, and that's what we're looking for. We're looking for options that are mispriced so that we can buy them when they're cheap and we can sell them when they're expensive. Greater option liquidity makes it easier to find good option trades. So that's the popularity growing only helps us. Some of you have heard me say some of these things before, and you're going to hear me say these things all the time as I keep going. Everyone that trades is going to have losses. It's how you recover from losses that separates elite investors from everyone else. And you already heard me say this earlier in the presentation. It's not about your win rate. It's about how much you win when you win and how much you lose when you lose, along with your win rate. It's always about balancing your risk, reward, and probability. Every successful trader has some kind of an edge or an advantage, and it's important that you know what that edge is, so that you know how to exploit it properly. And that means usually that you have some kind of a reason why you want to do what you want to do, right? And so that's really important, that you have some kind of an advantage or some kind of a quantifiable edge when you're trading. You don't need to accurately predict market direction when you have the right strategy. And I know that a bunch of you have been doing the collar trades and hearing about the collar trades, married puts. When we own stock, we're just buying insurance. It lets us participate in market gains without the catastrophe of risk, things that happened like 2008 when the entire market loses half of its value. That's a prime example of the next thing you're going to hear me say is over diversification is not how you beat the market. These new guys in school, they're taught like crazy that diversification is the answer to market returns. It's the answer to avoiding risk. But the market as a whole lost 50%, 57% in 2008 to 2009, and that was a tragedy, especially if you were retiring back then. The money's just gone. Well, you can't afford to do that, especially if this is your retirement account. You just can't afford to lose that much money in one shot when the market just takes a bath like that. You've got to make sure that you have some kind of hedge to protect you in case the market has a downturn. You still want to participate in the market on those upswings when they're out there, but you don't want to participate in the downswing. And if you can avoid that downswing, you start at a higher point when the market starts moving back up. And what Kevin's been doing, and the strategy that we all love here, is that we're exercising those. We're not exercising the puts. We are cashing those puts out and buying more shares when the market goes down like that. So we just reset right away, and our break evens a couple dollars above the stock price instead of waiting for it to go up 100%. For those of you that maybe don't know, in 2008, the market took the big bath. It did recover, and most of those brokers are out there saying the market always comes back. Just hold on, the market always comes back. Well, you had to wait till 2013 for the market to come back. So you lost 5 years of making money while you were paying somebody fees. If you were in a fund, or if you were paying an advisor to have you in a diversified account, something that's over diversified, then that's what's been, that's what your experience was. And just it's silly when it's so easy for us to prevent stuff like that. And so that's what we do that's different than other people. We're not going to over diversify. We're going to keep you in those, there's a few percentage of the stocks that are listed that actually account for the majority of the growth in the index. If you can stay in those, you have a shot at beating the index. If you don't, then if you're investing in the index and paying fees, you have it's almost a guarantee that you're not going to outperform the index, right? So the other thing you're going to hear me say is when volatility is extreme, it is easier to predict future volatility than it is to pick market direction. And that's why I'm a volatility trader. If you look at the volatility index right here, so the volatility index, VIX, is the implied volatility of the S&P 500 index. It's a complex calculation, but it just measures the rate of change, how quickly things move in the index and how big the moves are. And when volatility gets to an extreme low, like it was here, and again, I know JP, you know this right here, when we were loading up on positions that profit from increases in volatility, and then we got this big boom right here, and then it calmed down a little bit again. Oops. Sorry about that. And it calmed down a little bit again, and then took off even higher right here. And then it's calmed down again right now, but we're really close to average. So volatility has a central tendency. And what that means is that when it gets closer to zero, it's going to go back to the average. It's a revert to the mean property. When volatility gets extremely high, it's easy to bet that volatility is going to go down in the future, and you can take advantage of selling strategies, selling strategies to be profitable on that. But it's difficult. It's as difficult to predict where volatility is going to go as it is stock when the volatility is close to the average, because it could go either way, up big or down big. You just don't know. But when it's at an extreme, you do know it's much easier. The probability is that it is going to return to the mean rather than going further, more extreme. Oh, let's see. That's what I want. So some recent news I want to talk about. So I last week Kevin was talking about how, do we think that AI is done, that the bubble's been there and it's about to pop, or do we think that it has more room to go? And we do think that it has more room to go. We don't think it's quite done yet. Some news stories, think Micron, which is one of our stocks that we've made some good money on and added some shares. Kramer says that there's more upside and he's buying it on dips. Or that he would buy it on dips, not necessarily that he is buying it on dips, but that's a different story. So that's kind of interesting. And CNBC also says NVIDIA has to rally. They're expecting it to rally more than 30% as deal making ramps up. So I don't know if you knew about this, but NVIDIA just put a big fat check into Intel's hands. So they're deal making, and we'll see how that rolls out for the industry. So that's kind of interesting. It's kind of putting Intel into my watch list, because they, if you want to talk about undervalued assets, it's probably undervalued if all these big guys, the government and NVIDIA, and they're asking Apple, and so if they can make some deals and get Intel out of the funk that they've been in for a while, that might result in something there. And so that's one of the things that I'm watching. This is interesting. The next one, the resilient stock market may be keeping the economy out of a recession and why that's a bad thing. So it's interesting what this article, what they found is that some people, if the more wealth somebody has, if they're investing in the stock market, if they own stocks and they've been making money on the stocks, they're more likely to go out and buy stuff and spend like normal. And they're more likely to have positive sentiment about the market. But if they don't have as much of their nest egg in the stock market, those people are feeling less confident about the future of the market, and they are not spending as much. Then CNBC said, don't count out a pullback in the fourth quarter, strategists say. So that's one of the things I want to talk about. So, and you can see here in the big picture, which I know Kevin talks about the big picture here quite frequently, and that they're saying that valuation always matters in the long run, and that's true, right? Earnings reports are important. If a company is meeting expectations, then the stocks continue to go up. If they don't meet expectations, the stock can end up going down. But it's interesting because earnings themselves don't always matter. In fact, I would say they don't really matter. The earnings number doesn't really matter because it's the market's reaction to the numbers when they come out that matters. And that's going to be dependent on the bigger picture, which is kind of interesting. That's provided by the big picture. So we've got a situation right now where people are worried about valuations. They're worried that these AI stocks have blown up, and they're starting to think that we might be getting close to the ceiling when the bubble might pop. And so that's a potential issue out there. But typically what I found is, so if you remember when Greenspan in 1996, Greenspan said the words irrational exuberance. I don't know if any of you remember that. Irrational exuberance. And he was worried about the state of the market, and and that was in 96, and the market kept going up and kept going up, and it wasn't until 2008 that the stock market crashed, right? So 1996 to 2008, that's more than a decade, right? Isn't it? Yeah, that's a long time. That's a long time for the market to continue to run when the Fed chair wasn't confident, right? The dot-com bubble, exactly. Yeah. So we've got these bubbles that form, and they can go on for a long time. And what we're watching for, and what I watch for, is what are the potential catalysts that could cause that valuation to become a problem? Because as long as the stocks keep running up, as long as there's still buyers to keep buying, and people aren't afraid to buy at the top, they're not worried about it right now. It doesn't look like, anyway. What are the potential catalysts that could cause this thing to flip over and for people to start saying, oh, it's over? That brings us to something that we'll find out tomorrow, right? Government shutdown, potentially. Is that really a catalyst? I don't think that that's really a catalyst, because here's the funny thing about this specific potential government shutdown is that what's the important data that we need right now that everybody's looking at? And it has to do with the Fed, and this is a potential catalyst. If the Fed if they don't behave the way the market's expecting them to, so if they don't lower rates 3 more times this year, as people are kind of planning on, then that could be a potential catalyst that says, oh, the Fed's not lowering rates. That's not good. If they're trying to fight inflation, they're still continuing to try and fight inflation. If inflation is not being tamed, then they can move the market and they can make it crash. And that's, Volcker, that's what he did. He raised rates. When I was a kid, my dad was paying 18% on his house. And it's just kind of crazy that there's that hype. But he was like, I don't care what it takes. We're going to tame inflation. And so if the Fed turns into that kind of a situation, then that's something that we may have to deal with, and that could be a catalyst. It could be that they just want to stick it to Trump and say, hey, we're independent, you have no say, and they just decide we're gonna prove it. You don't have any say. And that could be something. I don't know what it'll be. Typically government shutdowns don't necessarily cause many issues with the market as a whole. It causes problems for government. But here's the factor this time is if they shut down tomorrow on Tuesday, if they shut down tomorrow, BLS, let's go look at BLS. Here's I like looking at Econoday for my calendar of events that are going on this week. But what is everybody paying attention to? They're gauging how the economy is doing because the Fed is lowering rates to support jobs. Well, guess what comes out this week? We have an employment report due on Friday. And I think you guys have probably heard Kevin make fun of the ADP report that comes out on Wednesday. It's a jobs report, but it's, I think you've heard him make fun of it. But if that's the only thing that we have, so if the government shuts down, the BLS won't have a report on Friday. So we won't get an employment report. We won't be having the data that we kind of need to help us make decisions. And so then what are we left with? The only thing we're left with is the ADP report and whatever speculation other people and economists have about what the numbers might be. And so it leaves us in a situation where volatility could increase because people are just uncertain. We're more certain when we have more data. We're less certain when we have less data. Or we're certain when companies know the rules, right? And this is why tariffs and the back and forth on tariffs and foreign policy are so hard sometimes, because when companies know the rules, they operate just fine. When they don't know the rules, it creates uncertainty, and they don't know how to plan for it, and they don't know how to attack it, and they can't expand. So they start saving money and they start reducing inventory, and they, because they just don't know how to behave. And so that's one of the issues that we have to be concerned about. So this government shutdown may stop us from getting data that we really kind of need to have a good idea of what the Fed may do at the next meeting. If the employment report is showing continued weakness, then it would bolster chances for another rate drop. If the data says that the economy is doing great and wonderful, and they don't have and they had good data, better data than they expected, then the Fed may switch to say, hey, we're going to focus on taming inflation again. Bill's asking a question. BLS doesn't release stats. Won't the conference calls give enough information? Unknown. So if the government machine that they've got that collects all the data is down, then even the Fed won't have data to talk about in their press release. And so I don't know how they would handle it or how that would play out. Yeah, but if BLS doesn't release the stats, then we'd go back to earnings, right? Because the government doesn't have anything, but we'd go back to earnings, and that's why earnings are important and why we look at earnings all the time. And so that's an important thing to look at. And speaking of earnings, I know that we talk about earnings each week. So today, none of the symbols on here that announced earnings today were really anything that we were too worried about. And I think that's the way Nike, I don't know if any of you have Nike positions, but Nike does report tomorrow. Conagra Brands, CAG, that's one I like to trade. None of the big names that are focused are doing earnings this week, other than maybe Nike. I think occasionally we invest in Nike. I don't know if anyone has open positions right now, but yeah. So this week the big things that we'd be worried about are the employment report, which we may or may not get. If we don't get the earnings report, then people will probably rely more heavily on the ADP report, which the quality of that is questionable. Just not sure about how the market will react to that. We've got a lot of Fed speakers that are out there talking this week. So typically when Jerome Powell is talking, he can move the market up and down with his words. These other Fed speakers, occasionally they will make comments that spark some big moves, but not as reliably as the Fed chair. So their words are important to look at to try and get an idea of what the Fed as a whole might be thinking, but it's not as important as the Fed chair. Let's see, what else do we have this week? I think that we've got home price index, PMI, consumer confidence. Yeah, so these numbers that are going to come out before noon tomorrow, we will get consumer confidence, we'll get PMI, and we'll get the home price index, and we'll get JOLTS, job openings. But after noon, if the government shuts down after noon, who knows what we'll get. So it doesn't look like we have any other announcements after that, but until we get to tomorrow. And then we've got manufacturing, PMI, and other stuff up there. But if the government shut down, what data we're going to get is going to be questionable. So we just don't know. Let's see. That is, I think, everything that I have. Does anyone have any questions? I'm happy to answer any questions you might have. Give people a second to type. Oh, thank you. Yeah, I'm really glad to be on board, and I'm excited to be here and to be with such a good company that takes care of people. I love helping people. That's primarily what I like to do. I'm just an entrepreneur, and I always look for ways that I might be able to help people. Let's see here. I think Kevin's here. I need to make you a presenter to talk, Kevin. I'm going to make you a presenter. So just in case Kevin has anything to add, I want to give him a chance to talk here.
Okay, I don't have too much to add today. I just wanted you guys to hear Brian here where he's an expert at. Again, next week we'll go back so we make sure we get all of the information out to you on what's happening that week and why. We'll put it into a format that you guys obviously can read on the My Hurley Investments. And we're good. We're welcome Brian Strain. I got to finally pull him away from a guru in the education. And again, he's going to help me out with some of the smaller accounts to make sure we're actively growing those accounts using some more option strategies without having to own the stock ownership and get those all up to 100,000 or more. That's the game plan. But guys, I appreciate you being with me here this week. We look forward to talking to you next week. We're delaying to see if you guys have any other questions, but if you don't, have a wonderful evening. Appreciate you being here. Thank you, Brian, for taking over. And we'll talk with you guys next week.
All right. Thank you, everyone. Thanks, JP. That was a great comment. Thank you. We'll see you guys next week. Have a wonderful evening.